All right, ladies and gentlemen, I have a special guest on the show today, Ian Formigle. Ian is a real estate professional and a serial entrepreneur with over 25 years of experience in real estate private equity, equity options, trading, and startups. Ian is Chief Investment Officer at CrowdStreet, overseeing its marketplace, an online commercial real estate investment platform that has completed, we've just updated, just about 500 offerings, totaling 16 billion of commercial real estate. Ian is the author of The Comprehensive Guide to Commercial Real Estate Investing, and he's a contributing author at Forbes.com. Ian, how you doing today?
I'm doing great, Jesse. Thanks for having me on the podcast. It's a pleasure to be here.
No problem. So that's fantastic. We just updated a few of those numbers before the show. So congratulations on what you've done there. I can't wait to get into the weeds and talk a little bit about that. But before we start, as we do with most guests on the show, we'd love to hear a little bit about your background in real estate. You know, how you got the bug, and a little bit of your journey to where you are today.
Yeah, no, happy to do so. So, as you mentioned, my professional career is a little over 25 years at this point. It did not technically begin in commercial real estate. It got there. It began in derivatives trading. So for the first 5 to 6 years of my career, I was what you call a pitch trader. I was an equity options market maker. I stood in the crowd. I wore the jacket and I traded options predominantly on Microsoft for a number of years. And it was kind of during the dot-com bust in bear market of the 2000 period where I had the opportunity to kind of start pivoting towards real estate. I had been fortunate to kind of get a head start in my career and had some capital to deploy. And while I wasn't seeing the opportunity necessarily anymore in derivatives trading, I was starting to see opportunity in real estate. So like most investors, I started where we all start. We buy a second home, we buy a rental home. And then I bought some more after that. So for the first few years, purchased, managed, rented, fixed, and ultimately flipped single family homes in California and the Sacramento region. And it was from there that it kind of sprung me after doing that for a few years and realizing gains and wanting to do 1031s. It's what got me embarked on into multifamily. So then I kind of started transitioning to scale. Started buying 20 to 30 unit buildings, eventually turned that into 150 to 200 unit buildings. I became a multifamily syndicator for a number of years. And then during the great financial crisis, during a period where I wasn't syndicating, but we had Class B, predominantly garden style multifamily deals in the South and Southeast that were doing okay, but we're hanging in there. So then I set my sights on wanting to get into large scale commercial real estate. Was really excited and enthused about the idea of really taking it to the true large institutional level. Had an opportunity to join a commercial private equity group. I did that, spent the next years, doing what we call GP/LP deals with large sources of institutional capital, deal sizes ranging from $25 million to $150 million per transaction. And then really learning, large scale office towers, large business parks, million square foot industrial buildings, retail shopping centers, and the like. And then from there, in around 2014, it was kind of the accumulation of that experience that set the stage for talking to the founders at CrowdStreet and joining them, and as the platform got going, to be the chief investment officer. So they were looking for somebody who had a breadth of experience across investing, different asset classes, understood how to structure deals, kind of how to ask the right questions, and then partner with groups out there to bring deal flow to what is, to our marketplace. And so it's been an amazing journey. Luckily, that has worked out. And as you mentioned, we've now done about 500 deals, about $16 billion of total real estate. And so I guess it's been, I feel a little bit tired some days, but a high velocity commercial real estate career is kind of where I sit right now.
That's great. That's such a good arc in the story. It's not dissimilar from so many people that get into our world where, you're starting with single family and moving up the ladder. And it sounds like you were doing syndicating before syndicating was cool. And it's the big buzzword now in real estate. Before we get into where you're at right now and CrowdStreet, you were a University of California, Berkeley, if I remember correctly. So when you were investing, you talked a little bit about investing in the South. Those first few deals, when you started to syndicate, which geographical area were you doing those deals?
Well, okay. So again, the first single family homes were, like I said, in the California, in Sacramento region. And then around 2002, 2003, that's when we pivoted to multifamily. And those first deals were in Birmingham, Alabama.
Hmm.
And so what was interesting at the time is that I had a very West Coast centric view. I'm West Coast born and raised and educated. And so it immediately started to translate into, hey, if I don't want to do single family homes in California anymore, because at that time the pricing felt high. Remember, I was a volatility trader, so the homes went from 220 to 350 in a few years, and so I view that as high volatility.
Yeah.
I tend to sell high volatility. I like to buy low. So then it became, where do you buy? It quickly looked like, okay, multifamily at the time in California felt pretty high priced, even Seattle, Washington. I looked at Phoenix, Arizona, that felt a little high priced. And so I paused at that moment. I said, let's assemble a model. Let's let the data tell me where to go. Clearly, I want to remove my own personal bias from this next decision. So at that time, I assembled a fairly rudimentary but 3-tiered model that contemplated first top line macroeconomic drivers, kind of the job growth, population growth type of stuff, like where are people and money flowing into a market in the United States. The second layer of that analysis was kind of micro market and true like market drivers, things like cap rates. Where are cap rates now to relative to where they were then? What are happening with rents? How is asset pricing looking today? What looks attractive and relative value? And then the third was the time of, I'm a fan of an economist by the name of Richard Florida, who at that time had written a book called The Rise of the Creative Class. And so after reading him and being a fan of his thought process, I said, really the final part of this analysis has to be a subjective layer of, why would you want to live here? Could you live here? And my litmus test was, I'm going to assume I'm a corporate employee and I just got transferred to this city and I need to live here for 3 or 5 years. I don't need to retire here. I don't need to necessarily live my whole life here, but could I live there for 3 to 5 years and enjoy my life for that period of time? And so after I assessed that whole market, Birmingham, Alabama kind of stood out. And also particularly from the standpoint of, it had steadily appreciating, real estate that wasn't flying off the charts, but it wasn't going down. And remember, I was coming off of a scenario where I had been fortuitous to have some gains coming out of California, and I was looking for capital preservation. So I didn't want to jump into the next market that seemed like high growth, but potentially bust. I wanted to park money, feel good about what that money was doing, and then, turn 2 and 3x multiples over 3 years into 10, 20, 30% returns on an annual basis, right? Say, let's grow wealth, but let's not just go bet the ranch again on another high growth market. So it was those factors. When we thought about all 3 of those layers, Birmingham just stood out. It was attracting population out of Atlanta. It was becoming a healthcare destination. The real estate was affordable. We could buy multifamily with at price per doors that looked really cheap now. It was $40,000, $50,000 per door. And it had, and then to that part about the kicker of the subjective view, it was interesting. We went down there and had a nice experience. And at the time, I had a friend actually who was managing large bands that were national, some headliners. So he would travel all over the country with a couple of his bands. And I said, at the time I said, Pat, and I lived in San Francisco at the time. I said, Pat, hey, you go all over the country all the time. What do you think of Birmingham, Alabama? And he said, I love Birmingham. We have a great experience every go there. We sell out, great crowd. He's like, we love to hang out in 5 Points. I'm like, very interesting. I'm looking at a couple of deals right now that are walking distance from 5 Points in Birmingham. He's like, oh, great submarket. Love going there. When you go back down there, let me know. Maybe I'll come visit. We'll go hang out and I'll show you all the cool bars and restaurants. And that, to me, that was it. That was the kicker. I was pretty much in on Birmingham from a macro and then micro market driver perspective. And then now I have the context of my friend who goes to 40 cities a year and knows the life blood of those cities, and said, yeah, you're making a good choice if you want to go park money in Birmingham. So that was it. That's how I got started. And we did some deals there. We ended up doing deals in Dallas, Fort Worth. Did a particular specific deal in Oklahoma City, as well as Louisville, Kentucky, and some other places. So that was my multifamily investing experience.
That's great. So before we go to a little bit of the overview of the commercial real estate asset classes, I'd like to just ask you, in those initial deals, you talked about eventually doing a GPLP model in private equity, but those initial deals, when you were, I assume, syndicating them, was it single asset syndications, or did you kind of grow that into a fund or fund of funds type of model?
It was single asset syndications, and it was literally the friends and family model. What happened was, after we invested in California, uh, people were interested. They kind of looked at what we were doing, and at the point where we were selling single family homes in California, and we were realizing 2 to 3x multiples within a few years. And then they asked, well, what are you doing? They said, well, we're going to go invest in apartments in Birmingham. It was friends and family money that approached and said, can we do that with you? And when we initially started, my wife and I at the time were just thinking about going and buying an apartment complex or two of ourselves to say, hey, we made some money. Let's go translate that into some units. And it was at that moment, and it was actually my wife who first called it. She said, well, Ian, if these people want to come to you and invest, like, isn't this what don't you form a company partnership and you start doing this? And I said, yeah, that's interesting. That's called syndication. We can do that. So that was it. That was the impetus for starting our small multifamily platform.
That's great, Ian. That's it's a really cool backstory to kind of see the different markets on the podcast that people gravitate towards. So it sounds like you did the technical aspects, and then you just needed that third subjective, a friend or family saying this is a great place. So I want to back up. So one of the great things that I found about finding you online and the resources was you had a conversation where you talked about commercial real estate really holistically, and it was a discussion of multi-residential, retail, industrial, office, and commercial real estate in general. And what I'd love for people to hear is that 30,000 foot view of the way you approach commercial real estate for listeners that maybe, have invested in single family or even gone into the multi-residential side, but don't really know as much about the other verticals.
Sure, I'd be happy to. So when we think about commercial real estate, there's just a number of factors that start to enter the equation. And for starters, there are different markets around the United States. Obviously, there are different markets that are suited to different types of commercial real estate. And so if we once we enter the commercial real estate arena, we want to drive, we want to really think towards, first and foremost, okay, let's talk about macro drivers, because macro drivers are highly important. But then once we start to peel the onion back a little bit, we then can get into the conversation of saying, okay, well, now if we think we have a thesis around this city, this metro, it's growing, it looks great. Now we can actually have the conversation about, now we need to think about what are we going to do in that metro? Because that one strategy might be brilliant. Take multifamily. If people are just showing up, they're showing up in hordes, and they are millennials. They're not looking for, to buy homes right now. They're looking to rent apartments, and they're trying to kind of find their footing in a new, really fast growing market. Well, then that's going to translate into absorption of multifamily, right? Now, meanwhile, if you think, now let's talk about industrial for a minute. Well, that market may have like very little connectivity to industrial. Maybe it's over in the corner of the country. When we think about industrial, we have to think about distribution. We're trying to shove things around the country. And we need to do that through both space. Industrial is very land intensive, right? It doesn't stack up 40 stories high. It's usually a building on a ground with clear heights that range from 25 to 40 feet. And you really need good ingress, egress, and you need transportation infrastructure. You need good highway systems. And then you need drivability, proximity to a lot of people. So where does that translate to? It translates a lot to the middle of the country, right? You think about Indianapolis, you think about Dallas. Like, these are places that have all of those things. You can drive within 4 or 5 hours and get to a lot of people. And they are relatively land unconstrained, while San Francisco is like 100% landlocked. So those are just things that you have to start thinking about when you think about investing. So when we look at it, for example, we're going to think about overall like types of strategies that work right now. And as we enter 2021, we think that multifamily works, definitely. We like industrial. We like other niche asset classes like self-storage. We understand that retail and office sit right now in some levels of dislocation, and hospitality, major dislocation in hospitality. But we also know that those markets will ultimately come back. Let's talk about hospitality for a minute. It got absolutely decimated in 2020. The tsunami hit it. It is absolutely crushed. But we also know that as soon as we can get to the backside of a pandemic and return to a life that's normal, isn't every one of us itching to get back out and go somewhere and experience something?
The roaring 20s.
The roaring 20s, right. So I totally agree. So I think when you look at that kind of market, it's just understanding where you are, that real estate is cyclical, and industrial is just kind of up and to the right now because we've just spiked online sales, and now they might even regress to the mean a little bit in 2021. But we're now on a trajectory to meaningful, progression of online sales by 2030. I mean, the estimates are roughly 30% of all sales online by 2030. We kind of punched into about the 20% range this year and are back down kind of in the high teens. So, but hospitality, for example, that's just a market that's crushed, but it's going to bounce back. So if we think about investing in hospitality, it is, am I getting the appropriate discount to what it would have traded at, because it is distressed. It's not going to have income right now, but it will most likely in the future. The markets that were desirable to travel to will be desirable again, right? So in just looking at those locations and those metros and those destinations to say, did something really change? Sometimes the answer can be maybe yes, and then you pause and you understand that. But if the answer is no, I think, take Orlando, for example. I'm pretty confident that once Disney opens, there's gonna be a lot of people staying in Orlando hotels again. 75 million people like to go to Orlando every year to experience Disney and Universal Studios and the like. So I think that stuff's coming back. It's just about appropriate capitalization of that deal to get back to normal growth rates, which we expect in hospitality to happen 22, 23, and by 24, probably fully back to where we were in 19.
So if we broaden that hospitality out to retail in general, right now, I can't remember the stat exactly if it's 27 square foot per person, the traditional quote of, overbuilt, under demolished. What's your, if we just focused in on retail, what are your thoughts like on the future of retail, without having a crystal ball, and maybe more specifically, what the assets, I know you mentioned that you're going to have to capitalize, you're going to have to figure out what the adjustment is, but also, there is that dislocation and trying to figure out, what happens with these. Do these get converted to industrial? Do they get converted to single family? What's your view on that for retail?
Yeah, very interesting years upcoming for retail. So I think there's a bunch of stuff to unpack there. So for starters, I'd say in the next year or two, I think two things happen. There's some bifurcation in retail, and there's also consolidation. Mm-hmm. So by bifurcation, I mean, let's look at what's working in retail today. The grocery store is working really well. Yeah. Grocery stores sales doubled during the pandemic. So we reset. And what was interesting is that you could trace grocery store sales back 20 plus years. And what we just did in the pandemic is we reset the portion of our food budget that we buy in the grocery store back to the mid 1990s levels. Wow. Because between 90s and now, we had this proliferation of restaurant, new food concepts, all the stuff. So we were going away from like, hey, we now eat out more and more. Now we eat out very little. So we're back to that 1990s. Now we're gonna bounce back, and we're gonna quickly kind of jump back probably into 2005 to 2010 zone. But it's gonna take a little while for us to kind of resume eating like we did in 2020. So you know that for the foreseeable future now, not only was grocery anchored retail viable in 2019, it proved during the pandemic that it's resilient, and actually it's the anchor of what we do need. So it's very relevant to our day-to-day lives. And I think, to me, that's the important point. When we think about retail, what is its relevancy to you today? And what is the probability of that relevancy staying there for the foreseeable future? And if the answer is good to both, and it's relevant to both of those questions, that retail center is not going away. It's the ones that lose their relevancy. They get old, they get tired, they're in a location that the momentum is going away from them. They start to degrade in the level and the quality of the tenancy. And then it's at that point, and maybe they have a big box that goes vacant and it doesn't get released. It's those kind of catastrophic changes to a retail center that then lead it to being redeveloped. And redevelopment does happen in retail. So a good example is we did a deal on our platform a little over a year ago, and the operator was based in the Southeast, and they did a deal in the Philadelphia metro. And it was the conversion of a large box retail in a retail shopping center. So they took just the large box and they converted it into self-storage. And so this property had been sitting there. It kind of lost its relevancy for big box retail. but it sits in a good part of the metro with a lot of cars outside, in proximity to a lot of rooftops, and also with a relative dearth of supply of self-storage in that submarket. So the operator came to us and said, hey, we're going to redevelop this thing. We're going to take, and it has high clear heights inside, and you don't even have to. So what you do in that building is you create the storage inside the building at the normal storage height, and you just have the clear heights above it. So it's all lit, it's all nice. You can drive around inside it, and then you can just roll up your own doors and then stick your stuff in. Well, that deal is now under contract to sell, and now they're looking at a substantial gain. So those types of things. So, there's creative destruction that happens in commercial real estate. And so you can actually make money in that scenario. To say you can buy empty retail and make a lot of money if you know how to repurpose it in the right way and just make it, again, relevant to what's going on in the submarket, because we still need physical space, right? I mean, that's the one thing. It's like, well, we do shop online, but we live in a physical world. And until we stop living in the physical world, we do need space for something. We need space to do those things with that we're buying online, right? I mean, so it's just thinking through the next level of like, what are we doing here? How is this going to work? Do the things that we think happen. If we continue to have trends, do those trends work against me or my favor? And if they work against you, is there a way to like pivot and make that work in your favor?
Yeah, that's great. I think my dad would be happy with the stat for eating at home. Why are you going out for food? You got a perfectly good kitchen at home. But that's great. And so if we slide over from there to, my sandbox, we talked a little bit earlier, what I do as a day job into the office world, we are seeing bonus commission fees in downtown metros. We're seeing the sublease market flooded in a lot of areas because companies really don't know what their plan is for the next 12 months, let alone 5 or 10 or 15-year leases. Let's talk a little bit about office, and maybe we can organize it by downtown and suburban office.
Sure. So let's take downtown first. So there's no doubt that downtown office has short-term disruption associated with it in a lot of markets, but I would characterize it as short-term. There's definitely, and the reason we can see is that in what we saw throughout 2020 was you saw, a lot of office users that still have viable business models that are getting work done from home. So the good news is that we were, and thanks to things like Zoom that we're on, we were nimble. We all pivoted and we figured out how to get some work done while we were sheltering in place. But what that puts office users in the perspective of right now is to say they're not yet mostly back in the office. Some markets are more utilized than others. You've got markets like Dallas that are approaching 50% utilization right now. Meanwhile, San Francisco and New York still sit kind of down in the 10% range. But the answer is everyone's coming back to work eventually, but we don't really know what that looks like. So you have office tenants saying, I don't exactly know my future office need today, so I'm not going to make any bets right now. I'm not going to lease more space because I'm not using it. But there will become a time where they're going to need to lease more space again. That will probably start to occur even just later this year. And so you could even see that in the renewal activity. You lease office space, you understand what that market looks like. We saw 6-month and 12-month extensions. I characterize that as kicking the can type of strategy.
Yeah.
We don't want to actually have the hard conversation of what we're going to do. We're going to all agree that we're not going to have that conversation to next year. Landlords and tenants were happy to agree to not have to have that conversation. And what we do understand is that when we get back into the office, it's going to look somewhat different, short term for sure. And it may look different midterm or long term. But really what we don't really know yet is from now a space utilization perspective in the midterm, does that equal less? Does it equal the same? Does it equal more? What we can probably know is that the work from home phenomenon is going to stick around to a percentage with a lot of employers. But the percentage is not going to be 30 or 40%. It's going to be like 10, 15%. There's enough data out there that suggests that the majority, the 80+% of workers that were previously in an office would like to return to the office at a minimum for like 3 to 4 days a week, if not 5 days a week. So office utilization is going to come back. And then there's going to be that segment of the population, the 10 to 15% that say, I think working at home is great. I think that's what I want to do for the rest of my career or for the foreseeable career. And we have companies that are going to support that. So, but then when we think about what that office space is going to look like, so we say, so there's one mode of thought says as well, like office demand is going to drop by 10 to 15% because these people are never going to return to an office. And the answer is, well, not exactly, because now we need to think about that space. Just use a really simple example, 10,000 square feet of space. Well, just because 10% of the office workers don't show up anymore doesn't mean you need 9,000 square feet anymore. It probably means you need to repurpose the remaining 1,000 square feet into something else that's more hotel-like, right? Because the flex space requires more space. We need more meeting space. We need collaboration. We need to be able to go hang out. And so what you're already starting to see is, and we're probably going to need to space out a little bit more for a while. I don't know how quickly people are going to want to immediately jump back into, I can reach out and touch 3 of my workers. Probably want to want some physical space. So that's going to probably equal some greater space needs per employee. So the way we can boil that down to a square footage per employee is 100 to 125 square feet per employee is probably gone for a while. You probably see that bounce back up to, 150, 200 square feet per employee. But some of those employees aren't there anymore every day. So it's going to be a big mix. It's going to determine, and it's all going to vary by which company. All remains to be said that when you put that into the totality, kind of bake into the equation, CBD office is going to have to go through that process, figure it out. But I'm very optimistic by the middle of this decade, we're back to record levels of office demand in the downtown.
Yeah, and just on that point, I think it was PwC that did the 2021 outlook, and a lot of this is they talk about the utilization of space and that we had gone to a point where we got almost too tight, where 100 square feet per person, and we went through a phase where every company is a collaborative company and everything needs to be open concept, and I think we were already shifting a little bit back towards that. But what I also tell people that aren't in the office world is that if you ask any people that do this for a living, they will tell you that a lot of this stuff had preceded or predated COVID. We were going in this direction. It definitely got kicked up a notch for sure. And got people that maybe would have never thought about doing their day teleconferencing or on Zoom or Hangouts, basically forced them into that. But I think this was a trend that was happening with office. And just that the second point on utilization, every time we have our workplace strategy group do a utilization study, it is just amazing how many companies will have the partners on the outside exterior and bums and seats are just, it's not there. They're not there. The utilization is so low. So I think you're right on right sizing the space. Before we move to Suburban, I would actually like to get your office, because you mentioned flex. I would like to get your office on your view on coworking and how, the last few months or year, the impact to them and what your thoughts are.
Yeah. So for the co-working space, and again, there's different models within co-working. I'm more of a fan of the management model. You take a building, you take the lower floors, turn that into co-working, and then you have the co-working user tenant kind of partner with the building and say, look, I'm gonna run the deal. I'm gonna get a piece of the revenue, but I'm fundamentally aligned with the office building that if one of these small users blows up and now needs 5,000, 10,000 square feet, I can lease them upstairs in the building. I'm not taking them down the street to another building. So Industrious is a good example of a co-working group that I think has the model that I see as sustainable. Co-working obviously was hit during the pandemic, but the reason I'm optimistic about it coming back is that it is for that 10 to 15% of workers who want to kind of stay out. And also the fact that we're now there is going to be some satellite effect. If we are a company that you take a company that employs 200 people, for example, and they're going to embrace a little bit more of work from where you want to work perspective, you might have 3, 4, 5 people now in various metros around the United States. That's too small to go out and lease office for, but it's perfect to go have a co-working space, because those 3 or 5 people are going to want to come together and collaborate and hang out. They're going to want to have some identity that I'm attached to a company. That company, may be a flight away, but I have 3 coworkers down the street. So why would I not want to actually hang out with them? Go grab a beer or go grab lunch with them. So I think that's the perfect spot for co-working. So I think co-working actually has a really interesting spot. Like watch it bounce back. Watch all these things come back and watch it absorb. once, again, this goes back to we have to figure out the future of office. That's going to take a year or so to figure that out. But watch in 2022, those companies come to those decisions, say, we're going to let people remain remote, but we've got a cluster here. It's not enough to go lease a whole full-blown, portion of a floor, but let's go plug them into a co-working space and go let them hang out, in an oversized, glass box within that space.
So I guess just to wrap up the office, thoughts on Suburban Office and 2021.
Yeah, so Suburban obviously sits in a much better place than CBD entering 2021. And I agree with you, Jesse, that you already saw the suburban trend coming pre-COVID. The data that I saw, if I recall, I think it was JLL or Cushman Wakefield that pointed out that, over the last, over what, 18 and 19, roughly 70% of office absorption actually occurred in the suburbs. It was kind of a little bit of like a not talked about, suburban office is not super sexy, right? It's more utilitarian. There was we wanted to talk about the cool co-working environment downtown stacked in the CBD with it, the new awesome cafe down the street. And that's still important, and that's going to be important again in the future. But meanwhile, suburban office was working, people were leasing it, people were using it. It's a lot cheaper than CBD office for starters. It's roughly, I think, like 60% of the cost across the country. So I think that factors, because again, if we want to draw that back to the office square feet per employee, well, if we're going to need more space per employee, I mean, cost is going to become a real issue in the central business district, right? I mean, that's expensive stuff. Go, look back at what New York and San Francisco was charging at the height, and it's over $100 a square foot. So now, but meanwhile, you could go, if you want to take New York, for example, okay, you're over $100 a square foot in Manhattan. I mean, you're $30 a square foot over in northern New Jersey. And meanwhile, a lot of your decision makers live there, right? They live in northern New Jersey commuting in. So maybe what's going to happen now is that they're going to say, let's do a satellite approach. We saw that in Boston, for example, million square foot user in the CBD, starting to shop for 50 to 100,000 square feet in the rings. And then there's this other concept that I've talked about before, where look at that inner ring suburb. There was momentum coming there. And I think where we sit kind of from a macro level is, the central business districts, the downtowns got a lot more livable. And there was this, the 24/7 live, work, play phenomenon. And that got a lot of press. But then what happens now is that as you start to think about that phenomenon is coming to the inner ring, the first kind of ring suburbs. And to the extent that you can now create live, work, play environments in the suburbs, that becomes really attractive because it's easier to access, it's closer to your home. If now the amenities that only were downtown are now in that first ring suburb, I mean, that's really what you want. You want the cool brewery, you want the cool cafe, you want the great restaurant. Like, you don't have to be in the city center to get it. Like that's an exciting experience, but let's also be real. It's a harder experience to access. It comes with really expensive parking, and it comes with traffic in and out. If I could replicate that experience in an inner suburb, and I can get access to a cool office, that I can then go walk to a cafe or a restaurant, and then I can go see a show or do something fun, and then I have a quick, easy drive back to my house. It's 10 minutes away. Like, that's attractive. So you were seeing that start to happen. That phenomenon is called hipsterbia. ULI coined that phrase last year. I loved it when it came out. Hipsterbia was cool. I'm like, I get it. Create the hip urban environment, but create it in the inner suburb. It makes an abundant amount of sense. So to me, that's the exciting part about suburban office, is that I like it. I like the movement. It's definitely got a COVID enhancement now.
Yeah.
But if I'm investing in it, I want to invest in it in the locations where I see there was momentum about creating what I call, like, it's got to be some there, right?
Yeah.
If I can find the there in that suburban location, then I'm all in. I want to learn more about that deal.
Yeah, that's a good point. And I chuckle a little when you say that the majority of the C-suite and live in Jersey anyways. It's actually sad to see to a certain extent how many multinational clients we have that we do all these sophisticated analysis of location, and then the office ends up being down the street from the CEO's house. So that is a real thing. So I want to be respectful of your time here. So we're coming a little bit close to the end here, but I'd like to really talk about CrowdStreet and your role and what you do with the company and the outlook that you have. We've talked about it throughout the show in 2021, but from an investor's standpoint and from the company standpoint, what are the opportunities you're looking for? What is the investment philosophy that you're maybe pivoting to because of 2021? And yeah, like, you know, what you do in the day.
Yeah. So, well, to take it from the top, really, what we do at CrowdStreet is it's just focused on trying to bring institutional quality commercial real estate investments to the individual investor. This is the type of real estate that years ago was just completely dominated by large institutions, the pension funds and the large capital providers out there. And it was what we called it was a club. If you were outside the club, you didn't have access. We took a website and a change in legislation, which is called the Jobs Act, and we transformed that into trying to then create, bite-sized, investment increments into large commercial real estate deals that now people like you and I can afford. And so that was the vision. And so now, luckily, it's starting to work. And so with that now, and then when turning it to like, well, what do I do? What I do out there, serving as the CIO, is that we are now talking constantly to real estate operators and developers across every different asset class, all over the country, every day, and getting to deal flow, and then evaluating that deal flow and determining if we think it's good, and is it also relevant and applicable to our marketplace? Does it fit with our investment thesis? So my job is to serve as the key decision maker and all that. So we have a capital markets team. They're primarily charged with having those grassroots down at the street level discussions, meeting with groups day to day, bringing in that deal flow. We then have an investments team that is charged with, picking that up, having conversations with the operators and developers, and then doing the first level of analysis and evaluation, and then doing a level of screening, and then bringing in the next level down to say, we think these are, viable operator, viable developer, good market. We think it's a good deal. We think that there's opportunity here, but there's still a couple remaining questions. Then it comes to my attention. I'm running an investment committee, meeting every day, evaluating deals, and then saying, is this really a fit or not? So my job is to really scrutinize it from there. It's made it through multiple levels to get to me, but I'm the one who's then has to come in, beat it up, ask hard questions, and say, have you really considered the angles? The person who's been around has seen it all. I've now seen 500 of these things, and I saw a bunch of deals throughout my career. Sometimes in real estate, just experience counts, right? You have to see things go good, bad, and in between, and like run through those scenarios. So oftentimes, probably the best thing that I can do, highest value for the investors on the platform, is something comes in, it has a business model attached to it, has some assumptions baked into it, and I'm drawing out something that I experienced 12 years ago to then say, well, what about this? Because when I was looking at something like this in 2010 or 11, this is what happened. This is what we didn't think would happen, but it did, and then it did, and this was the outcome. Have we thought about that scenario? One of my old mentors would say, like, we're in the what if game. What if this? What if that? And that's honestly probably the best value add that I can provide to the company and to the investors, is saying, really thinking through all the what ifs and then determining what of that eligible deal flow really makes the most sense. And then from there, our team picks it up and works on it and brings it to the marketplace. And so, and then from there, I travel around the country. I meet with, when we could. I'm not traveling around the country right now, obviously. But get out there, meet with operators and developers, tour markets, understand landscapes, meet with investors, and then really bring that richness of the context again back to that data discussion. We talk about at CrowdStreet that as we navigated 2020, really the question that we had to always ask was, why this deal right now?
Yeah.
That's it. Like, why this deal right now?
Yeah, that's a great point. And it reminds me of a little bit of Howard Marks from Oaktree, one of the memos on risk. And if people aren't familiar with him, Howard Marks, check him out. And there's this one graph that we all know from finance, risk return, and people just assume risk, higher risk means higher return. And the caveat with this is he says, no, higher potential return. And the thing that he has is on the graph, instead of a straight line from the bottom left to the top right, each portion of a higher return has a distribution, and there's risk in that each section. So that's really interesting, because real estate is one of those things. It really is a what if. It's not a percentage of, oh, this is the percentage risk. It's like, no, what if this happens and totally, messes up your deal. So, sorry, go ahead.
I couldn't agree with you more. I mean, first of all, I'm a big fan of Howard Marks. I read his letters. I think he's a fantastic and amazingly visionary, insightful investor. And he is so on point that when and I see this every day in the marketplace, it's easy for investors to come to the marketplace, look at a targeted return on a page, and assume that is like the most likely scenario. And we say, well, it is a point on a distribution. I mean, there's an infinite number of outcomes, really. What that number on the page, and this is usually phrased in the terms of internal rate of return. If that's a 12% internal rate of return or 15, it's just really the best guess of the operator developer. Has to come to a series of assumptions, of which like any of those things could go wrong. But then what we can do is we have to look at the texture of what's that real estate. And I totally agree with you. I wrote an article on that's on our website a few years ago. I called it the returns fallacy. And I said, you have to remember that what you are looking at a potential distribution curve. It's what you call a Monte Carlo analysis for every deal. And a core deal. So if you look at one property and you say this property is 100% leased, it has a 10-year lease term. It's leased by Amazon, let's just say, for example, an office tower in Seattle just traded with this scenario. What you're going to get. The probability of Amazon defaulting on you on its 10-year lease is probably, I would take that risk over treasury bills at this point, right? For like the value of what, right? I mean, because T-bills are they're getting debased, and the lease in Amazon has rent escalations attached to it. So that's probably a pretty good risk. So are you going to, over the course of 10 years, are you going to quadruple your money in that deal? There's no way, because your revenue stream is basically already fixed. You know what you're going to get from Amazon, when you're going to get it, and you know how it's going to escalate. And then from there, you take that value of that revenue stream and you apply, a reverse discount factor to that. That's the cap rate analysis. And then you can back into asset value. So over the course of 10 years, with that type of revenue stream coming from Amazon, if you put some leverage on the deal, but it's 50 or 60%, it's going to translate to about an 8 to 10% return. Yeah. It's not going to translate into a 30% return in it, but the good news is it's not going to translate into a negative 30% return. When you get out to that risk spectrum of like, I want to swing for the fences and I want to double my money in 4 years, I think sometimes that's when the investors, I encourage them to pause and say, with this money, are you prepared to lose it? Because now to get to that level of return, you're assuming that a bunch of stuff goes right, of which neither you, the operator, the developer, nobody can factually say that will happen. There's probabilities that each one of the things could happen, and then there's probabilities that they could not happen. And if 3 of those things don't happen, and they happen, and the outcomes are bad, we're in a money losing category, right? We have a building that's vacant. We're going to go put a bunch of money into it, for example, and then we're going to go lease it up, and then we're going to go sell it for a bunch more than we have into it. Well, that's a lot of assumptions of things going right. Yeah. And they don't always go right. So I love that question, because it really just stresses that when you look at a real estate deal and you look at a targeted return, it's targeted for a reason. It has a blend of different outcomes. Lower risk real estate has a narrower range of outcomes. Well, it has range, but we can definitively say the range of outcomes is lower on that core real estate relative to the range of outcomes at the high end, that opportunistic or development type of real estate.
Yeah, that's great. And it's funny too, when you talk about that internal rate of return, almost by definition, the one thing you do know for sure is whatever number you have in your model is not the number that it's going to end up being when you finish the deal. And it's just something that's so easy as, when I remember first getting into this, the cap rate that you put in, your reversion, the end cap rate on a model, that's sometimes a hand waving exercise. But the one thing I just want for listeners as well, and we're getting into the weeds a little bit here, but just to acknowledge that we had a professor, Frank Gallinelli, I think he was an instructor at Columbia's master's in real estate. And one thing he always said I really liked, he's like, that's not to say that we don't make assumptions. He's like, because people will say, well, how can you assume this, this, and this? And he's like, well, if you make no assumptions, that's your assumption. That's your no assumption model. That is an assumption. So what we try to do is figure out the best way, just like you're describing here.
Yeah, absolutely. Frank is right. I've read his book. His book is fantastic. He, again, somebody that I would look up to in the industry. And you're totally correct. You do have to make assumptions because, and the other thing you can think about is that you could put yourself for a moment into the shoes of the operator or developer. If you don't make any assumptions and you're not willing to take risk, then you'll never acquire a property because the market is willing to take risk and the market is willing to price that risk. So obviously when we look at that fully leased Amazon building, the amount of risk is lower, hence the amount of certainty of so the level of that capital that's going into that deal, it's willing to put more lower risk capital into it because they know they have the certainty of the revenue stream coming from Amazon. There's a different type of capital. If the building was 100% vacant, it's a vacant office tower in Seattle, for example, that has a value, it will have to have assumptions. If the assumption is it remains exactly as it is, then the value of that asset is negative. But I'm going to be pretty sure that if there was a vacant office tower in Seattle, it doesn't trade negative. It's interesting. There was a point in time where an office building in a city did trade for a negative value. So it can't say that it can't happen because I know of the story in the industry where that occurred. I'm not going to talk about who it was or where it was, but I know that somebody paid money to have an asset taken off their hands.
Yeah,
so it's possible. So that's the interesting. That is even possible. But a vacant office tower in Seattle will have a positive value attached to it, which means ultimately that the market has assumed that there is the high likelihood that somebody will come into that property in the future, somebody will lease it, and somebody will pay a rent, and that rent will turn into a positive return. Now, how, when, how much, and what will it cost to get there? That's why there's a price discovery process on that deal. That's why you expose that deal to the market. And it's ultimately the person who's willing to take the most risk today oftentimes ends up winning it. Not often, not always, I should say. Price isn't the thing that oftentimes drives the execution of that deal. A lot of times it's the certainty of execution over the price. So essentially, the group that is most credible, who's willing to also take the most relative risk, into the range, that's probably the group that wins that deal. But to your point, you have to make assumptions in this business or else you will simply do nothing.
Yeah, for sure. So we ask 4 questions to all of our guests, but before we do, I would just like to, generally speaking, ask you for 2021 with CrowdStreet, anything on the horizon that you're keeping an eye on, anything that you think is worth noting?
Sure. When we think about 2021 at CrowdStreet, we see opportunity in a variety of asset classes, geographies, and risk profiles. So for starters, let's just talk about big macro geo. We have been a proponent of the secondary market. That's phenomenon. We kind of have that as our secondary market thesis. We have been big fans of going around the country, the Denvers, the Austins, the Nashvilles, even the Atlantas, right? The Raleigh Durhams of the country. We're fully back in the saddle on that thesis as we come out of, what we view, this is basically this is a new real estate cycle that's beginning. We basically had a fast reset during COVID, and luckily the stimulus money with low interest rate environments basically kicking off a new cycle. So we go back first and foremost to saying those markets, we like those. We also, with a twist, we like mountain region markets. We like Salt Lake City. For some strategies, I think we even like Bozeman, Montana, right, for multifamily development. We also like Boise, Idaho. We think that's a market that's got great momentum coming to it with good things ahead. So those are probably the areas of the country where we see the most opportunities. These secondary markets that we've had, we saw people going to them. They had quality of life, they had affordability, they had increasing connectivity to the United States, through airport expansions and transportation and infrastructure and the like. Then when we think about asset classes, now, generally speaking, we think multifamily sits in a good spot again. It's the biggest beneficiary of the cheapest form of debt through agency financing, Fannie Mae, Freddie Mac. When you can buy an apartment complex and lever it with sub 3% debt, and right now cap rates are 5.5%. Well, there's cap rate compression that's going to go there. We're already seeing demand basically bid up those deals because the positive leverage effect and the yield on that deal is good. It's good relative to other things out there. So again, take multifamily, put it back into that secondary market that's growing. We think there's opportunity there. We think there's opportunity from both a ground up development perspective when it's not oversupplied in a market, and we think it's there from an existing asset perspective. We're also bullish on industrial. It's a no-brainer. It's the thing that has been absolutely stellar during COVID. To our conversation earlier, we just spiked our rate of online sales. We're on a trajectory to 30% of online sales over the next decade. We're undersupplied for industrial real estate in the United States. So we like industrial. We like existing kind of Class B in place, more oriented towards manufacturing, because that's the kind of stuff that they're not building manufactured oriented Class B industrial anymore because it's hard. The land is too valuable. But if you can find that close to a metro and it's under $100 a foot, it's going to have demand. We also like ground up, stuff when it comes to distribution, both be a larger box, the stuff on the outskirts of the city, that's the 750,000 to 1.5 million square feet. The stuff that's closer to the cities, that's the 350 and under. We think from a ground up perspective that if it has a distribution component to it, could have cold storage component to it as well. Or if it's oriented to the growth of e-commerce sales, we think that deal has legs. We like that. When we think about other asset classes, we start to get a little bit more cycle oriented, opportunistic. Office, there's a bifurcation of the office market. If you have weighted average lease term, so you've got long-term leases in place with credit tenants in a well-occupied building, that's kind of like a bond. So that we think that deal has value, but it's going to be value oriented to the cash flow type investor. Not going to set the world on fire on returns, but these days earning 5, 6, 7% yield when when T-bills are getting you 1%, it's pretty attractive. Other than that, if we think about multi-tenant kind of Class B office, downtown and suburban, want that to be a little bit more opportunistic, right? That's going to be relative value to where it was. We're assuming that leasing occurs. Things need to occur that haven't been occurring. You need to get paid for that risk. So we're looking at it from that. So we want basis to be low. We want market to be right. We want absorption that we think is on the horizon. And I said, we want to get paid for the risk to take it. We think about retail similarly. We want good value. We want good basis. Ideally speaking, we want that shopping center to be grocery anchored. If it's not grocery anchored, we want it to be the best thing in the market, top 1 or 2 locations, because that shopping center, even if it doesn't have grocery in it, but it was the best 1 or 2 things in its submarket pre-COVID, that's going to get bounced back. Maybe it had 3 or 4 different retailers blow out during COVID. We saw all the headlines. We get it. But what's going to happen is that it's the best thing in the best location. Coming out of the pandemic, it has the opportunity to lease up because there's going to be other groups that were pushed out previously that want to jump into the best location. So if you're in the prime spot, you'll be fine. To me, it's the 4th or 5th best locations. Those are the ones they're gonna flag. They're gonna ultimately maybe not recover. Those would be the ones, to our point earlier in the conversation, those are maybe the redevelopment plays of the future. So we'll avoid those for now. We'll look for the best stuff in the best location. And if we can find grocery anchored with the ability, and we like basis, retail works. Hospitality, opportunistic deals, discount to replacement cost, discount to 2019 levels. Good example is we did one opportunistic hotel deal on our platform in 2020. The large hotel, it's actually the Marriott Renaissance Hotel in the Baltimore Inner Harbor. Large hotel, it's 600 and some keys, major asset, major location, pretty empty in 2020. We were able to buy that at over 60% discount to the basis of the previous owner. In essence, if that building can operate, if that hotel can operate like it did in 2018, we're at about a 9 cap in a market where when it was trading normally, if it sold in 2018, it would sell for more like a 7 cap. 200 basis points of spread there equals really good value, really good basis. You got to put a lot of money behind that kind of deal, You can't assume that it's going to begin to operate anywhere near normal until 22. So that deal had a lot of reserves put into it. But that's the kind of thing when you think hospitality, it's like, look, let's take risk. No, eyes wide open. It's risky, but we could have a substantial return there. But again, for high risk capital, hospitality is a really interesting situation. Otherwise, when we think about the niche products, we love self-storage. We love it from a ground up perspective. We also love it from a value add perspective. Really interesting asset class. It's done really well over the last few years. It's very resilient, was totally resilient during COVID. From there, we get into other things. We've done a data center. We did a discounted note purchase on the platform last year. We can find that kind of like really interesting niche stuff. We obviously are a fan of the medical office space. We've done particularly like daily needs kind of use. We've done some dialysis center deals on our marketplace. You know, dialysis is kind of thing where if you need it, you're going to go to it. You can find great credit tenants in there. Fresenius is an example. We did a deal that was anchored by Fresenius in multiple locations around the United States, 10-year term, 7 to 8% cash flow. Really like that kind of strategy. All boiled up. There's a lot of different kind of steps. So which means, and what I recommend for any investors who want to check it out, we publish our investment thesis. It's on the home page of our website. So when you go up in the corner, it'll say resources for investors. You can go down and you can read the thesis. And you can read exactly what we're thinking, asset class by asset class, geo, what is kind of like what to expect, lower total returns but less volatility, and then what to expect, maybe greater volatility but looking for higher returns.
Yeah, that's a great summary. All right, we're gonna get into these questions here. So if you're ready, Ian, I'll lay them on you.
All right, let's do it.
Something you know now in your career that you wish you knew when you started out.
Wow.
Usually a long list, but there's a couple that usually come to mind.
Yeah, I would say that the thing I wish I knew now, I know now that I knew then, is to really think through. I think experience teaches you what leverage can and can't do for deals and the risk that it either helps you alleviate or insert. I would say more knowledge around debt, its structure, its pros and cons and its risks earlier in my career. The earlier, the better. I mean, you get beat up at some point and then you really kind of understand what debt does to you and what leverage does to you. Knowing that earlier would have been awesome.
What's a resource you would give the real estate investor listening? It can be a podcast, can be a book.
Okay. Yes, I have. There's 3 books that I think are great. I love books. I'd say I consume books and podcasts, I think, a lot. I also listen to, people that I think that are pretty smart out there, and I listen to them. So for example, 3 books that I think are great resources. One, a book by Peter Linneman. I'm a big fan of Peter Linneman. I think he's a fantastic real estate economist. He's a former Wharton professor. Now he has his own group called the Linneman Group. He wrote a book called Real Estate Finance and Investment Risks and Opportunities. Find that on Amazon, obviously. I think that's a great book to read. Another great book is Frank Gallinelli's book, What Every Real Estate Investor Needs to Know About Cash Flow and 36 Other Key Financial Measures. That was probably I read that book probably 15 times when
That's a great book.
It's just such a great tool. And that's probably my other recommendation. Like there's these financial metrics that help you start to understand commercial real estate, and you can't read them once. You got to read them, you got to exercise them, you got to read them again, you got to exercise them again. It is all about the repetitions, right? This is the 10,000 hours of practice that really makes you an expert. I think Frank's book is a great example of that. And I mean, third, I'll do a shameless plug from my own book, right? I have a book called The Comprehensive Guide to Commercial Real Estate. You can find it on Amazon. I wrote that book specifically for the CrowdStreet style investor, somebody who wants to passively invest in commercial real estate. So if you want to go active, that book probably has a couple of tools. It'll teach you about cap rate, equity multiple. It'll teach you about yield on cost and other things, but it's really more oriented towards, hey, I want to understand how to evaluate a deal, a private equity deal, and determine whether or not, what the operator or developer is telling me makes any sense or not. So I think those are 3 books that I'd recommend. Okay,
number 3, your view on mentorship.
Love it. You have to, in this industry, I think it is paramount. I've had the privilege to have 3 mentors, I think 3 really distinct mentors in my career. Each one of them did amazing things for me this step of the way. My first mentor was my trading mentor, the guy who hired me to trade in the options pit. taught me how to trade, taught me so many things about the early phase of my career. So totally thankful to him. Then later in my career, when I was at my private equity group, the CEO of that company, that was my second mentor. It taught me so much about thinking about commercial real estate, how to think about investors, how to think about investments, how to think about risk. And he had a very, huge storied career and different aspects. He was at one point one of the senior partners of CB Richard Ellis. So really understood, commercial real estate, the world of that, how it operates. My third mentor I have right now, he's fantastic. His name is Jack Chandler. He's the former global head of real estate at BlackRock. And he's the former CIO of LaSalle. So talking with Jack on a weekly basis has been absolutely fantastic. I learned so much from him on a weekly basis. So mentorship is absolutely key. Find the thing is, find the appropriate right mentor. I mean, I even go back to the beginning. There was a temporary mentor I had when I first broke into multifamily. I had a family friend who had been doing it for a dozen or so years. He basically had his own portfolio. He wasn't a syndicator, but he owned probably 600 or 700 units across 4 properties in the Southeast. And his name is Mercer. And so I called him up and said, hey, I think I'm going to go look at deals in Birmingham, Alabama. Like, what do you know? Like, what do I need to know? And he said, well, Ian, you got to start thinking about these things. And so he taught me so much about getting those, that helped me get those first deals done. So find the first appropriate mentor and then go from there.
All right. And my favorite, poach this one from Masters in Business and Bloomberg, your favorite car, your original first car, make and model.
It's interesting. Some people might not actually know it. My first car was a 1960 Sunbeam Alpine convertible, British Roadster. My dad, the reason I got that car was my dad he's a baby boomer. He was in college during the 1960s. He was a big fan of British Roadsters. He actually owned this company that they operated while he was in college that would repair wire wheels. Now remember, like when wire wheels were like a real wheel and they had knockoffs and you would literally knock them onto the wheel. So he owned Austin Healey's, he owned a Datsun Roadster and a couple other things.
Oh,
so
that's awesome.
He was like a total British Roadster kind of guy.
Yeah.
15 years old. He is now at this point, he was a civil engineer and he became a general contractor. So he's out there, remodeling people's homes in my part. I grew up in the Bay Area. So he comes home one day and he goes, Ian, I found your car. I was probably like 15 and 2 years and 2 days old at the time. I'm like, what are you talking about? You found my car? Like, I can't even drive. I won't even be able to get my permit for like 6 months. He's like, yeah, I found a car, but you're going to want to come check it out. And I'll talk to you about it when we go there. So it was at his client's house. It's sitting on the side of the house. It's under a big tarp. And he's like, this is a 1960 Sunbeam Alpine. It's this kind of cool British Roadster. It's very rare. You can't find a lot of them. And it didn't run. And so he said, I'll make you a deal. He's like, this thing's going to need an engine and suspension, a couple of things. Like it's going to need some work to get it running. And it looks like crap right now. So he's like, I will get it running, but it's going to take a lot more money to make it look nice. You make it look nice on your dime. I get it running on my dime. And you can have a British Roadster for your first car. And I was like, that sounds cool to me. Done. So we did it. I ended up ripping the engine out of that thing like 2 times. I mean, like, talk about a way to like get a kid to understand what, the basics of like car mechanics.
Yeah.
A British Roadster, it breaks down like every 5 minutes. So, I spent the next 3 or 4 years, restoring the car, working on it every day kind of thing. And then when I went to college, I couldn't take care of it because you literally got to take care of that thing like every day. So I sold it when I was in college and I turned that into like a Mazda RX-7,
That's awesome. That's awesome. I can, it's so fun. So you became a true British petrol head. And if I remember correctly, I feel like that it was Roots that was the manufacturer of that back in the day, but that's great. So I can 100% say we haven't had that on the show. So that's great. Listen, this has been amazing. I'm just digesting everything we just talked about. For those that want to connect with you, what's the easiest route? We'll put some show link to the book, but any other websites or links that we should put up?
Yeah. What I typically tell people out there is there's a few different ways to connect with me. The easiest way is I am the only Ian Formigle on the LinkedIn platform. So If you type in my name, you get right to me right away. And I love talking with investors about deals. I mean, you can tell I'm a deal junkie. So feel free to ping me on LinkedIn. I'm happy to chat. The second way, obviously, is just through the website, www.crowdstreet.com. There's a lot of information there. There's ways to get in touch with the company. I'm kind of one layer removed that way, but if people, it's, and again, given the inbound traffic, it's easier for people to kind of pick it up. And then if people want to get directly connected with, can take it from there. Those are probably the two key ways, but LinkedIn, I'd say, is the starter, and then check out the website.
My guest today has been Ian Formigle. Ian, thanks for being part of Working Capital.
Oh, it's been a pleasure, Jesse. I love the conversation.